Well, greetings to all my clients. My name is Walter Mazars. I'm a wealth manager, CPA with Trinity Wealth Solutions. Today's topic is going to be talking about stock market cycles, stages, and the economic cycle, how there's a lag between the two. But before I go on into the video, just full disclosure, this video is intended for my clients. It is not intended as investment advice or a solicitation to buy or sell any securities. So please do not make any changes to your current existing portfolios. If you're not one of my clients, please seek investment advice from your own advisor. So do not make any changes to your portfolios based on this video. So what you see on the screen is, I've talked about this a little bit before, is there's 4 distinct stages in a stock market cycle. And just real quick, there's stage 1, which is basing, stage 2, advancing, profitable trading, stage 3, topping, that's the stage I think we're in right now. Stage 4, decline, it's also profitable, investing, and back to stage 1, basing. So let's go step by step. Stage 1, basing, what that means is after a stock market correction, pullback, it could be 20, 30, 40, 50%. Then the stock market starts the next stage of slowly trying to recover, and it's advancing into stage 2, which is profitable trading or investing for clients. And then it keeps going up, and at some point it gets to stage 3, which is topping. And that's what we believe we are in right now, is stage 3, topping. That's what our research company is saying, based on many factors, which I'll go over later in the video. But we are in stage 3, topping. What does that mean? That means the stock market really doesn't have a whole lot more room to go. Could it go up? As we see here, it kind of goes down, then back up, and it's kind of treading water, but eventually it starts going into stage 4. How long does this last? Nobody really knows. But there's certain economic and indicators that tell us, hey, things are deteriorating. And that's kind of at the stage we're at right now. We hear layoffs, economy slowing down, consumer sentiment is really going down quite a bit. So this is setting a stage for eventually stage 4. Stage 4, declining, where the markets decline. We don't know that time frame or how much of a decline it could be. But that's also a very profitable strategy, or investing, where we can make money for our clients. So what's interesting is you can see stage 2 and stage 4 are the most profitable when it comes to trying to make money for our clients. So most strategies or advisors are going to say, hey, stay the course, don't worry, we're not making any changes. If you're losing 20, 30, 40%, don't worry, you're going to recover. Now, we totally disagree with that. Our focus is to protect our clients' portfolio. So what do we looking to do with our clients' monies when we start approaching stage 4? And I talked about this in a previous video on market recap. There's probably 3 sectors we're going to be looking at, which is gold is one of them, but the big one is going to be long duration bonds and potentially ETFs and maybe the dollar. So depending where the trend, which of these asset classes has the greatest probability of making money. But the key to understand here is we can make money for our clients here. Most advisors are going to say, hey, I'm sorry, we just have to stay the course because we're invested in everything. So your portfolio continues to go down. And at some point, sometimes clients can't take it anymore. They pull out when they're down 20, 30, 40, 50%. At that point, it's too late. you need to stay in the market because you don't know when the market could recover. So that's the stages. So let's talk about, I'm not going to talk about emotions, but stock market and economic cycles. There's definitely a lag. When I say a lag, because the yellow is the economy. Whoops, let me push this down a little bit more. So the yellow is the economic cycle, and the blue is stock market cycle. As you can see, there's a lag. As the economy starts to bottom, in other words, that's stage one from the economic cycle, what starts to happen is the market is already looking forward and saying, hey, this is an early bull, there's a recovery going on, and these are signals, transportation, financials, technology, as we move up, middle bull market, and then late bull market. These sectors tend to do well. And what we believe right now, we're at the topping stage, and exactly it's coming true. Precious metals, energies have done very well, and all these other sectors have been moving up quite well, with not in a straight line, but have had good rates of return. But again, what you see is the market is here, but there's a lag. The economy takes longer to recover. So what the stock market is doing is foreseeing the future 6 to 8 months out, where the economy is still struggling, but then eventually starts to recover, where the stock market has recovered much earlier than the economic cycle. And then, as we see here, the topping of the stock market, usually stock market starts to correct earlier as kind of the economy is peaking. And that's kind of where we're at right now with the economy. But the economy is starting to deteriorate. So there's early signs of, I'll call it a correction in the market. We're still not sure. Nobody knows for sure. But as I mentioned the last week, markets are in correction territory, over 10%. So it's just a matter of time before the economy starts to follow behind the stock market. So the stock market is really looking forward 3 to 6 months. It could be 12, usually 3 to 6 months. So it's early. It's an earlier indicator where the economy lags, eventually follows, and that cycle repeats over and over and over if you look at history. So how do we position our clients' portfolios is really dependent on this cycle. So if we go back to the 4 stages, we are right now in stage 3. That's our belief. That's what research is showing us. So the next stage is stage 4. And this is where a correction at some point will happen. There has to be a reset. Yeah, I think I mentioned in other videos, Warren Buffett, probably the greatest investor of our time, is sitting on $350 billion of cash. There's a reason why. He doesn't see value. In other words, he's a value investor, so he doesn't see any value in the market, meaning everything's overpriced. So he's waiting. He's waiting for a reset. Now, is that going to be within the next month or 2 or 3? Nobody can tell you. These are probabilities. But the signals are there. So it's just a matter of waiting. Right now, we are sitting on the sidelines. Our clients are invested in U.S. Treasury notes via an ETF BIL, earning about 4.3%. So we're waiting. At some point, if the trend continues downward, as I mentioned in the Stock Market Recap Weekly, we will be getting into most likely long duration bonds. So hopefully this helps. The goal of this video is to give my clients an idea of what tools do we use to determine when to be more aggressive, growth oriented into the stock market, or when do we go into the bond market. And we may even use like inverse ETFs. And there's a video coming. One of my clients asked me to do, what do you mean by inverse ETFs? In a nutshell, what it does is, if the probability that the market is going to go down, there's investments that take the opposite position. In other words, they're saying, okay, it's going to go up, but the inverse ETF will go opposite. It's going to go up in value. And I'll go into greater detail why that is, talk about inverse ETFs. Again, I want to stress, this video is not investment advice, so please do not take this as investment advice or an offer or solicitation to buy or sell any investments, or for you to make any changes to your current portfolio. Seek professional advice from your current advisor, or if somebody other than our clients is watching this, just give me a call directly on my cell, 586-873-8156. Again, 586-873-8156. Thank you for watching. Hopefully this added some value, better understanding of what it is that we're trying to do for our clients. Bottom line is, the number one objective is to protect our clients' portfolios. So thank you for watching. Have a great day, and we will see you soon. Take care. Bye now.